Welcome to Energy Unplugged, the leading podcast addressing the global energy transition. I'm Hugo Batten, Managing Director of Aurora across APAC. Today we've got a podcast on South Korea's energy system. Aurora held a launch event in Seoul in late August, and our guests are the Aurora team that developed the analysis that underpins our market and grid forecasts in South Korea. They're going to be sharing insights from our modelling, but having just spent a couple of weeks meeting with over 50 subscribers and friends in the region, we're also going to try and weave in some of the on-the-ground observations into this podcast. So today I'm joined by Patrick Tan, Market Lead, Wider Asia, James Ha, Head of Research across APAC, Dong-Guk Kim, a Project Leader from South Korea, Yeonjae Kim, an Analyst from South Korea, and Chris Ikonovsky, an Associate who's focused on South Korea. Welcome, everyone. Just to structure up this discussion, we're broadly going to break it into three parts: a market overview, then part two, key long-term drivers of market outcomes, and thirdly, some insights from Aurora's South Korean forecast. So James, maybe if I could start with you, can you just paint the picture, some key stats and facts around the South Korean energy market, just to give our listeners a sense of the size and market structure?
Yeah, let me start with capacity, price, and kind of what's been supplying the market over recent years. So the Korean market is more than 140 gigawatts of installed capacity. It's a system where peak demand can exceed 90 gigawatts, and we've actually seen new records for demand set this summer. Its wholesale price is the system marginal price, and this is typically averaged in the range of 80 to 100,000 won per megawatt hour prior to 2022. Of course, during the global commodities crisis, that price doubled in line with rising gas and oil prices. But it's come down this year and is averaging about 130,000 won per megawatt hour. On the generation side, the system is getting about 90% of its energy from thermal sources, and that's roughly a one-third split each between nuclear, which of course is zero emissions, coal, and gas. And the remaining 10% of generation is mostly from renewables, with solar being the main source there. Just in terms of what's getting installed in the country as well, we're still seeing new capacity added, so about 5 gigawatts of capacity a year for the past 5 years, and about 2/3 of that is actually solar.
And then for any renewable developers out there who are thinking about the South Korean market, could you give us a brief overview of the key routes to market and just at a high level how the market is structured?
For sure. Maybe I'll do the second part first, because there's sort of three main underlying commodities which are traded, those being energy capacity and renewable energy certificates. And these are administered by KPX. There's a few other things to consider as well, like ancillary services and carbon. But really for renewables, the things that are most important are energy payments and RECs. Now, often these can be traded years in advance. For renewable players, there's really three main options in terms of route to market. So that is come into the spot market and go merchant. Second option is participate in auctions. And the third option that has recently become a bigger deal is PPAs. So particularly for the solar capacity that's been built over the last few years, we did see a period of time where auctions played a really important role. As during 2020 and 2021, we saw auctions run that were heavily oversubscribed, and these auctions really aimed to bring on capacity that would help Korea meet its renewable portfolio standard. But in 2022 and 2023, we started to see a lot more projects come to market via the other routes, so spot market participation or corporate PPAs. Part of the reason here is that we saw the emergence of a corporate PPA market, which had previously not been possible, and almost a gigawatt was signed last year. And the spot market was also of interest to players in the market because, as I mentioned earlier, wholesale prices were really surging through 2022 and 2023. And that made spot market participation relatively more attractive than participating in auctions, where the auction price caps didn't change very much, even though the underlying cost of electricity had risen a lot in the global commodities crunch.
And then, like a lot of markets, South Korea has a kind of series of reforms that are being proposed by government. And I think when we spoke to people on the ground, there's a certain degree of reform fatigue or confusion. Could you maybe pick out a few of the major reforms that we see impacting our forecasts? And then Yonjay, I might bring you in to talk about some of the trials that are being run. But James, if we could start there.
You're definitely right about the reform fatigue. We catalog 38 different reforms that are underway in our power and renewables market forecast. And these are basically aimed at modernizing Korea's power market and helping its transition towards net zero. The reforms really aim to do that in two ways. So the first way is making sure there's the investment that's required. And that means improving the economics of lower carbon sources like renewables and storage, while still maintaining investment in the technologies that are needed to meet the demands of Korean power users and make sure there's reliability in the system. The second way that the reforms aim to ease the transition is by allowing more efficient real-time dispatch, which is important as the share of weather-dependent renewables in the system grows. So given that there's so many proposed reforms and that most of them are planned to be introduced over the next 3 years or so, there's a lot of detail that the government will need to iron out and a lot of detail that the market is waiting on. And some of the reforms that are proposed, like nodal pricing, we've observed generally these have taken much longer to implement in other markets. Given how much uncertainty there is then about the future market design, we had to make a few assumptions about the market to do our modeling. And we had to really make design choices around 6 key market features. And those are who participates in the wholesale market, how are spot prices set, what do capacity markets look like moving forward, what do renewable energy certificates look like, will the current renewable portfolio standard continue? The fifth area was what do we do about locational pricing, zonal pricing, or just sticking with the current setup? And finally, how do we deal with curtailment? And some of the reforms to address these issues, we've already seen them tested in Jeju, which is a small island. It has about 1% of Korea's power demand and has been used as a sort of test bed for this new modernized version of the Korean power system. So generally, if we've seen reforms tested there, we were more comfortable about assuming them in our central case for the mainland as well.
Yeah, Yonjay, maybe if I could turn to you there just to talk through the Jeju trials, Jeju being the small island off the south of Korea that James just referred to. I suppose at a really high level, what did we see in those trials and how do we think that will impact the mainland?
Yeah, for sure. As James mentioned, some of the new reforms have already been implemented in Jeju Island as a pilot project. And even though it was a testing period from March to May, the results provided a brief outlook on how the new market design will impact the SMP once the reforms are rolled out nationwide. As most of we might already know, in Jeju Island, renewables are allowed to beat prices into both day-ahead and real-time markets, and the new system allows renewables to beat negative prices as well. And as a result, the new market rules have depressed S&P by around 50% in May, resulting in more price volatility throughout the period. And the thing to note was that the impact would be even more severe during spring and autumn season when curtailment occurs more frequently. For example, during May, around 20% of S&P were either zero or negative prices due to relatively lower power demand and high solar availability. And this result gives an implication that knowing curtailment rule is going to be getting more critical in determining bid prices. What I mean is that if a renewable plant is earning RECs, the plant can still break even on a short-run basis, even if the S&P price is negative, so long as it's still above the negative REC value. So for a merchant asset, the profit maximizing trade is to beat down to the negative of whatever subsidy it's receiving to maximize its profitable generation.
Yeah, super interesting. And negative prices, an increasingly hot topic globally. I'm currently dialing in from Australia. I think the prices have been negative literally all day today. So certainly relevant at the moment. Just as we're talking through this, probably two observations. And James, I might come back to you here. I mean, one is the incredibly important role of KEPCO. They have a monopoly on retail and transmission and have been, I think it's, kind of fairly I'm trying to think of the right word, but fairly obvious they've been losing quite a lot of money over the last few years as wholesale prices increase, and they haven't been allowed to pass that on to consumers. So they play a very dominant role. And it's going to be interesting to see how that plays out. The feedback on the ground is that KEPCO are just not going to be allowed to increase their prices in line with what you might expect the additional wholesale costs and transmission to come in at. Was that your sense from the discussions we had with clients in Korea?
That's right. Many of our clients recognize the fact that the KEPCO industrial tariff is probably, it is below where it needs to be for KEPCO to return to profitability. We've seen that tariff increased over the last year. And even in the last week, we're recording this in late August, the minister announced that he anticipates future price rises here as well. We've done some analysis on what would be needed to return KEPCO to profitability. And the short answer there is that tariffs can't come down. They need to rise pretty consistently, both to make up for how much debt KEPCO is already in and to deal with our future forecast of where the S&P price will clear out.
Yeah. Terrific. So hopefully we've painted a bit of a picture there of what the market looks like, although, again, Korea is a very large and complex market, so we're just scratching the surface. Maybe we could dive into a couple of areas in terms of long-term drivers of market outcomes that will kind of hopefully add a little bit of detail. And let's maybe start on demand. So, James, how do we see demand evolving in South Korea over the next 20 or so years?
In our forecast, we have demand rising from about 550 or so terawatt hours today to about 720 terawatt hours by 2040, which after that point, we continue to see demand growing to about 800 terawatt hours by 2060. So not inconsiderable amounts of demand. That's about a 1% growth rate per year. Unlike some of the other markets where we operate, population growth is not really the main driver in South Korea. Instead, it's really electrification of transport and new industrial demand from things like data centers and semiconductor manufacturing. The government's keen to support the Yongin semiconductor cluster, and it's projects like that that are really expected to drive electricity demand growth. I'd note that even faster demand growth might be possible if we see more policy to electrify industry, for example, a lot of the steel making that occurs.
And then, particularly as we're thinking about rising supply to meet that demand, I mean, in a lot of markets Aurora operates in, particularly in Asia, it's the state of the grid that is the biggest slowing factor, just spare network hosting capacity, and then subsequent losses and curtailment. I know grid data is extremely hard to access in Korea because there are a range of national security concerns. There is a long-term plan published. What is the state of the grid in Korea and how is it constraining new build renewables?
Yeah, and it's a good flag to bring up transmission here, Hugo, because we do see this as a potential handbrake on demand growth. It's one of the reasons why our demand forecasts are a little bit more bearish than the government's own demand projections. What we've observed in the transmission plans that Korea has released is between subsequent reports, we're seeing major transmission projects regularly delayed. Just as an example, the Dongducheon-Yangju line in Seoul capital area was initially planned for completion in 2019 in the 6th transmission and substations plan. We're now up to the 10th transmission substations plan, and over that time, the project's timing slipped by 5 years, now out to December 2024. These sorts of delays are pretty common across the markets that Aurora is covering in APAC. And some of the reasons for this include the complexity of these large transmission projects, opposition from local communities, long lead times on components, and sometimes poor performance from the companies that are actually contracted to do the construction. In the absence of really granular grid data in a country like Korea, we need to make some high-level estimates about what we think the grid can host in each region of the country. We always do our modeling, not just at the national level, but we break it down into different sub-regions so that we can look at things like the renewable availability and resource quality in those sub-regions, as well as trying to estimate how much capacity can you export between these different subregions of the country? So that's really been our approach in the near term, as we're continuing to work on developing our grid modeling capability for this market.
And I might bring you in here, Dongguk, because you've had quite a lot of experience in your career, both prior to Aurora in this space. Whenever we enter a new market, we come with a series of assumptions around particularly renewable and storage capex, but then we deep dive into the supply chain dynamics, labor costs, terrain of a given region to try and more accurately reflect actual capital costs in that region. The feedback, particularly from subscribers and experts, was that capex is really materially higher in Korea, even than comparable markets in the region. Could you talk a little bit about what drives that? And I think it's probably most pertinent in offshore wind, where the government is looking to roll out both fixed and floating offshore wind. So there are auctions for both coming up over the next few years.
Yes, Peter, yeah. So unlike Europe or Taiwan, the capex for renewables, especially offshore wind development in Korea, is significantly higher. And I think there are three major factors that drive those higher capex involved. The first of all is the lengthy regulatory and permit processes. So in South Korea, obtaining permit for offshore wind farm requires 29 relevant laws to be met, as well as going through the 10 different central and local governments, so which takes at least about 68 months to completely clear the permitting process. So the longer it takes to obtain the permits, the higher the overall project costs that can become, as there involve multiple on-site measurements, meetings, and related administrative work involved. And especially on the environmental impact assessments, there are strict standards that are in place to assess and minimize the environmental impact of offshore wind farms. And these typically requires additional studies, investigations, and measures that require at least 1 year length of measurements. And the next is actually on the limitations on technical and infrastructure limitations. So as developers are increasingly looking for larger capacity of wind turbines, mostly those wind turbines and the related parts have to be imported from abroad, especially Europe. And this incurs additional costs such as transportation and import duties. And as South Korea's offshore wind industry is still in the early stage of development, there's a higher dependency on external technology rather than domestic development of those wind turbines and the related technical parts. So there's also limited infrastructure, including wind turbine factories and ports that are available to produce and assemble those large components necessary for offshore wind farm constructions. So this necessitates additional investment in infrastructure and time. So it further drives up the costs involved. And I think last but not least, I think there's still a strong opposition from local residents and fishermen. So there's often opposition from local residents and local or neighboring fishery groups who are concerned that offshore wind farms might affect their fishing activities. So as official compensation process requires more than a year of investigation and agreement, this also leads to additional costs during the negotiation processes or even delays in the project development. So all these three elements actually drive up the capex in the South Korea.
Yeah, I mean, super interesting, Dongguk. I mean, I know James touched on it a little bit, but it is worth noting that, Korea is about half the size, I think, of Great Britain in terms of land mass. I think it's 50 to 55 million people. So the density is incredibly high. So when you start to talk about kind of opposition to projects, it's really palpable. It is a very densely populated place. And we've certainly had, I think, pushback from clients on even our more conservative onshore renewable build out assumptions as a result of that. So that all makes sense. James, again, it's a little bit of a potted selection here in terms of some of the long-term drivers we're focusing on. So we've hit demand, we've hit grid, we've talked about capex, particularly for offshore. Maybe if we could just finish up with nuclear. And the Koreans seem to be almost the only place in the world that is delivering nuclear on time, on budget. They're building, they have built new nuclear every 2, 3, 4 years for a long period of time. There's a whole supply chain and government infrastructure around it. Could you talk a little bit about the assumptions we're making over the long term on nuclear new build in the country?
nuclear is a bit of a swing factor for Korea, and we run some scenarios and sensitivities that look at different pathways here. It's a technology class that's highly influenced by government policy, as KHNP is the dominant player in this particular part of the market, and that organization is a subsidiary of KEPCO. Nuclear as a technology class is a priority for the current president, President Yoon Suk-yeol, who scrapped his predecessor's plan to actually phase out nuclear energy in the country. And he's set more aggressive targets, basically, to achieve 30% nuclear in the power mix by 2030. Because it's an area that will be so heavily influenced by government policy, central case is aligning with the 11th Basic Plan, which is the most recent one, on nuclear build-out, and that sees capacity grow from 23 gigawatts today to 37 gigawatts by 2039. Of course, with these large infrastructure projects, there's always the risk of cost overruns and project delays. And so we definitely run a scenario that tests the delay of that nuclear build-out and how that might affect both the SMP price and other capacity that's required in the country.
Yeah, and my understanding is that it's the Korean nuclear company that is winning auctions outside of Korea as well. So I think they just won one in the Czech Republic over EDF. And I think that just reflects the strong track record of the Koreans to develop new nuclear, again, approximately on time, on budget, which seems to elude parts of Europe.
Absolutely. Yeah. If it's going to happen anywhere, it's probably in Korea that central case will align with government targets. Especially, as you say, the domestic supply chain is strong, the expertise is there. The only possible thing that's missing is bilateral support, which is why watching the outcome of elections and the policy preferences from each of the two main parties is so important.
And so to the third part of the discussion, some insights from Aurora's long-term forecasts on Korea, and maybe if I could kind of set the scene here a little bit and then turn to each of you to ask some more specific questions. So just in terms of the capacity and generation mix, like a lot of markets, I think we see capacity mix evolving in kind of three fundamental ways. You've got the baseload technologies, and as James outlined, in Korea at the moment, it's coal, gas, and nuclear. We do see some growth in both nuclear and gas as coal exits the system by 2050. So that composition of that baseload changes, potentially even a role for hydrogen long-term as well. The second part of the story is really the growth of renewable capacity. We think a lot of that will be a solar story, but it is reasonably heavily constrained by land and grid availability. And that's a mixture of both rooftop solar or behind the meter solar and grid scale. And then we've got a mix of wind technologies. So some onshore, about 20 to 24 gigs, but again, constrained by land. Most of the onshore wind sites we're seeing in Korea are quite small and often in mountainous terrain because that's the best wind is, so expensive as well. And then a reasonably sizable role for offshore, and about 2/3 of that fixed, but 1/3 of it floating, again, reflecting the kind of relatively steep Korean coastline. The third part of the story is what Aurora typically refers to as flexible assets. And here we're particularly talking about battery storage of various durations, and capacity payments to bring those on, as well as peaking assets, whether that be gas or again hydrogen over the long term. So we do think total capacity will double, something like that, over the next nameplate capacity over the next 20, 25 years, to meet that rising demand that James outlined. Even with these fairly aggressive renewable growth rates, we're still a little bit behind the official targets from MOTI. So just as an example, under MOTI's 11th Basic Plan, they're targeting 70% carbon-free generation by 2038. In Aurora's scenarios, we see something like 63% by 2040, And then more specifically on renewables, Modi's 11th basic plan targets 33% of generation from renewables by 2038, whereas Aurora Central scenario gets to something like 30% by 2040. So again, I think we're trying to factor in the kind of real world constraints into these forecasts, and are slightly more conservative, as James outlined, than some of the government forecasts. Patrick, it's easy to talk about capacity mixes in 2050, and we'll probably have moved on from our respective roles by then. At least I hope we'll have. Could you talk about just the build rates for renewables in Korea over the last 5 years to anchor our listeners, and then talk about kind of what you need to deliver each year to hit some of those long-term targets?
Yep, definitely. And I think the headline message here is definitely it is feasible to expand the power system in Korea according to how we have laid out in our Aurora Central case, given that we have considered some of the real-world frictions in deploying these technologies, such as grid constraints, high capex, land access, and etc. Now, if we compare the build rate against the historical, our central forecast indicates about 4 gigawatt of renewable build rate on average for the next 15 years, whereas historically we have seen about 3.7 gigawatt of renewable build rate on average in the country. Therefore, it's definitely feasible as long as we can keep up with the current pace. And I think the real question here is really how much more does it take for Korea to reach net zero by 2050? And in our net zero scenario, our forecast actually indicates that we need an average of about 7.5 gigawatt of renewable build rates is required to achieve net zero target. And this is essentially almost 2x of current build rate that we have seen in the country. Multi also shared their ambition to ramp up the renewables built to about 6 gigawatt per year, which is pretty ambitious. But all in all, a lot of work has to be done, and probably government intervention will be required to resolve some of the challenges that we've seen in the market and unlock these build rates.
Maybe just to come in here, Hugo, some of the concerns around whether we can maintain that build rate really relates to the transmission network in particular, not just dealing with, is there enough capacity on these lines to get power to market, but are there enough bays at the substation to plug in these projects? Typical project sizes are much smaller in Korea. It's easy to, saturate all of the connection points. But assuming that investment happens to unlock the transmission as required, we're looking at a fairly similar build rates to what we've had historically in our central case.
And then, Patrick, we've talked a little bit about capacity and generation there. How do we see that translating to wholesale price dynamics? And I'd probably make a couple of caveats before you dive in. I mean, one, again, the SMP matters in Korea, but again, most renewables, as James outlined, PPAs, government contracts, RECs play a really important role. So SMP is really just part of the story in Korea. But also, if you could talk about not just about averages, but how we see intraday and seasonal shapes playing out in Korea, because particularly wind has a really seasonal shape. Wind output is much lower in summer compared to the other seasons, and that and it's highly correlated, right? Because again, we're talking about a small land mass. If you could talk a little bit about that as well.
Yeah, for sure. Maybe in this case, let me break down the question into 3 parts. First, let's go through a little bit on the SMP price forecast under our Aurora Central case, and then we can touch upon a little bit on the intraday price shape that we would expect as Korea entering a renewable intensive system. And lastly, on how would all these things stack up together in terms of overall long-term prices. Would it plummet when we have so much more renewable generation in the mix, essentially? So let's touch on the first bit, where in our central case, we forecast the wholesale SMP price to stabilize around 100,000 won per megawatt hour long term. 3-part story here. In the short term, till about 2030s, we forecast the price to slightly trend down to about 90,000 won per megawatt hour, as some of the committed new coal plants entering the system, and trending upwards to about 110,000 won per megawatt hour has more gas entering the system to firm up the energy supply. And between 2030 to 2050, we forecast the price to gradually come down to about 95,000 won per megawatt hour as more renewables are being built in the country. And towards the end of 2040s, we actually forecast a slight bump of price back to about 110,000 won per megawatt hour as some of the final coal capacities exited the system and being converted into hydrogen plants. And lastly, in the long term, we forecast the price to stabilize around 100,000 won per megawatt hour. I think three things to note here. Number one is with our long-term equilibrium model, typically we don't model the unforeseen extreme events such as war, pandemic, etc. And therefore, based on our forecast may look relatively more stable and less volatile. Now, as much as we love to tell you when is the next war or pandemic will be, unfortunately we can't. And that's why we also run alternative scenarios and sensitivities to gauge the range of these market outcomes. Now, in our low case, we forecast about 60,000 won per megawatt hour long term. In our high case, about 170,000 won per megawatt hour. This kind of gives you a sense of range if these events do occur, likely how it will behave within these ranges. Another point I want to highlight as well is, as Hugo that you mentioned, is first of all, the numbers that I quoted just now were all our annual time-weighted average S&P prices, and therefore it does hide some of the price volatility that we are expecting as Korea transition into a renewable intensive system. In particular, if we deep dive and investigate the intraday price shape, you will actually start seeing the solar duck curve getting more pronounced post 2040s, in which this leads to my third point I want to go through, which is on how things will shift, how shifting into a renewable intensive system will change the overall market dynamics, I would say. Very often we were asked by the project finance communities on, even though we have relatively high renewable or zero carbon generation, why the prices are not plummet or depressed. Now for Korea, under our central case, we forecast that by 2050, there will be about 70% of the generation coming from zero carbon sources, for example, nuclear and renewables. And to answer these questions, we actually pull out our model results for the year 2050 at the hourly granularity, and we rank this data in ascending order from the lowest price generation to the highest price and generation. Now, what we found was very interesting. Even though the zero carbon contributes to about 70% of the total generation, the flexible thermal technology, such as gas, in this case, is still expecting to set the price 90% of all times intervals.
You know, to some degree, that's a reasonably consistent finding across markets at Aurora, that it is quite hard to decouple your power system from your gas system, particularly in places like renewables, where in places like Korea, where you've got a ton of constraints. So that makes complete sense. In the interest of time, I might move us along. And, James and Yonjae, you kind of touched on it at the start, but rising or increased risk of economic and grid curtailment. And one of the major bit of pushback I think we got from clients was that, any move to sharper locational price signals would be tough because there are real constraints between the south of South Korea, where most of the renewables are building, and the north of Korea, particularly the Seoul region, where the majority of demand is. Could you just touch on how we see both grid and economic curtailment as a risk in this market? And, my take is that there seem to be quite varying approaches from market participants. Some are extremely worried about it, some are less concerned. And that's probably partly a function of where their projects are located, but also maybe whether they've experienced these kind of issues in other markets. James, maybe you can start.
It's a really live issue, Hugo, particularly on the grid curtailment side. While we were actually in Korea, some of our team attended an industry event on potential rules of how curtailments would be borne by market participants. And that event demonstrated that there is not yet agreement amongst industry for what would be fair in terms of how we manage curtailment and how we allocate those risks across the existing generators and across new entrants. Certainly, grid being one side. The other form of curtailment that we think will become increasingly important is the economic curtailment risk that is rising. With the move to a wholesale market where renewables can bid in and bid, we expect, at negative prices, we would expect to see a rising frequency of negative prices in Korea. Now, we're already seeing that on Jeju. The mainland, it's not yet really an issue, but over time, particularly as the renewable share does grow to 40%, from wind and solar towards the end of our forecast, we are expecting to see negative wholesale prices in the order of up to 20% of the time in some years, and that's relatively high. It's not just the renewables that are bidding in to the market at negative prices. It's also the fact that there's a lot of inflexible thermal generation still in the system by that point, especially nuclear. In that world, if wholesale prices really are negative that frequently, it's going to become increasingly important for market participants to estimate their curtailment risk, which will be partly a function of how they decide to bid into the wholesale market. If everybody else is bidding at negative levels because they're receiving a subsidy, and your plant bids into the market at zero to try and avoid exposure to negative prices, you'd probably be expected to turn down ahead of the rest of the fleet, as that poses some real risks and will become increasingly important as PPAs starts to be negotiated that factor in that risk over the horizon of the contract.
Chris, maybe if we could finish up with you and talk about what are the implications for large energy users. So famously the KEPCO industrial tariff, the amount KEPCO charges large users for power. This is super important, both because Korea is a very kind of manufacturing, industrial intensive country, but it's also a really important benchmark, for example, for any corporate PPAs that are signed. And demand for corporate PPAs is high. It's a seller's market, so prices have been high, but the KEPCO industrial tariff does remain a really important benchmark. Could you maybe talk about where we see that going, and maybe in a scenario both where KEPCO at some stage returns to profitability, but also a scenario potentially where political pressure remains on KEPCO to keep its industrial tariff suppressed and therefore protects the industry?
Yeah, for sure. So, in order to forecast the industrial tariff, we require for KEPCO to, recover both their energy supply cost, which is based on our long-term S&P forecast, as well as the network cost and the additional investment that's required, not only to upgrade, but also to expand on the transmission network infrastructure that's going to be required throughout the energy transition. So, in order to come up with this forecast, the long-term outlook for the KEPCO industrial tariff, a view needs to be made, as you said, on whether KEPCO is able to fully recover their costs moving forward and potentially a return to profitability. And as you mentioned, this plays a big role in determining the long-term magnitude of the outcomes for the tariff. We do note that as of end of June, KEPCO had a combined debt that stood at 202 trillion won, up around 440 billion won from a year earlier. And the last few years, as you mentioned earlier, have been particularly difficult as they've struggled to increase electricity prices given increasing supply costs of fuel, particularly coal and gas. So, we also need to make a view on whether KEPCO are able to react dynamically against those wholesale market outcomes that are impacting their costs. And, while the government does have the right to reject KEPCO's proposal to increase the tariff, to ensure competitiveness of these industries in Korea, James did mention earlier on that the industry minister has announced the intention to increase electricity prices to help ease the financial burden on KEPCO, despite the mention that there has been strong performance by, semiconductor industries as well as other energy intensive industries. With that said, if we assume a return to profitability, we forecast steady increases in the KEPCO industrial tariff over the coming years. And in the longer term, that premium seen between the industrial tariff and the S&P price is more so a function of the level of profitability that you assume, as well as the expected level of transmission network infrastructure investment.
Yeah, and again, understand the logic of that. It is a pretty live debate on the ground. There's a lot of old Korean hands who just think what you've described is politically infeasible, and the KEPCO industrial tariff will remain flat, and there'll be various kind of behind the scenes funding arrangements to keep KEPCO afloat, even if its primary product is being sold at a loss. So I think, what we're trying to do, at least for our subscribers, is provide a couple of different benchmarks there to paint a plausible range of outcomes, but understand the logic of what you said there. So, Chris, again, maybe to wrap up here, given all of that, how do we see emissions evolving in Korea? And maybe if you could kind of just benchmark it a little bit for our listeners so they understand how Korea racks up against comparable countries and maybe some European benchmarks.
Yeah, so, during 2022 and in recent years, fossil fuels have accounted for about 65% of the electricity generated in Korea. And so this puts the current levels of, network-wide emissions intensity at just above 400 grams of carbon equivalents per kilowatt hour. So yet, while this share of fossil fuels placed Korea below the Asian average, it does sit well above the average of other OECD countries, which is about 52%. So, with this being said, the near term, we do see current levels of emissions persisting, as there are additional plants coming online, particularly some coal and gas assets coming online in the near term. However, from the 2030s onwards, emissions are forecasted to fall steadily, which reaches about a 72% overall reduction in emissions by 2060. These reductions are primarily going to be driven by the retirement of the aging coal plants, as well as the conversion of some of these plants into lower or zero emission fuel sources such as LNG, ammonia, and hydrogen gas, which reduces the overall market-wide emissions intensity. Moving forward towards the end of the forecast horizon, what we typically find is that it does become increasingly difficult to remove the last 50 grams of carbon dioxide emissions, per kilowatt hour out of the systems. And typically, in order to do so, it does require governments to pull policy levers particularly hard to get there. And as such, it is expected that LNG will still play a role in Korea's electricity market post-2050.
Yeah, super helpful, Chris. I think maybe let's wrap up there. I mean, my reflection as all of you are talking there is Korea, like a lot of markets, has a few fundamental tensions in its energy transition. But I think they're almost particularly acute given some of the kind of natural endowments of Korea. I mean, the first is that there is this, and I think we did some calcs, that it's about a 500 trillion won opportunity in terms of new generation investment required by 2050. But at the same time, there's a range of rising policy, grid, and social license risks. Another really obvious tension or complexity is, you've got this increasing zero carbon and close to zero marginal cost generation entering the system, but electricity prices are likely to stay level or even increase, given it's going to be international LNG prices setting the margin 80-90% of the time, even out into the 2040s. And then I think the third tension is really, and James, you touched on this quite nicely, I think, market reforms boosting efficiency of investment and dispatch, but the government intervening in ways to maintain guardrails on the energy transition, but also to solve some stuff outside of electricity markets. For example, keeping supply chains in South Korea, and not over reliance on, for example, Chinese manufacturers for solar, wind, and batteries. So that's going to be a difficult tension to negotiate as well. As I said at the start, we've launched in South Korea. We're incredibly grateful for our clients and friends who've helped us out on that process. And hopefully this brief podcast has given you a sense, at least, of how we see the South Korean market evolving. A huge thank you to Patrick, James, Dongguk, Yeonji, and Chris. You were all terrific. Thank you for your time.
That was Hugo Batten, Managing Director of Aurora across APAC, talking to the team that developed the analysis underpinning Aurora's market and grid forecasts in South Korea. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.